Perfect. So thanks, Manuel, for the great introduction. I assume you can hear me and also see my slides. Perfect. If not, please let me know. Yeah, so thanks for having me. My name is Jonas Gross. I'm working for the Frankfurt School Blockchain Center. And besides that, I'm writing my dissertation about digital currencies, or to be more precise, about central bank digital currencies. And therefore, it's really a pleasure for me to today talk about central bank digital currencies, which is a topic we already had. It's quite some sessions today. Nevertheless, I'm happy and I'm confident to share some different insights. So when today, starting with the conference, Philip Sandner actually said that there are basically two impacts of the CBDC, or two dimensions. And the first one is really about setting up the technology, providing kind of at least potentially a blockchain-based means of payment. And this is something we discussed today quite intensively. And the second one is about the whole economy. So it's about the macroeconomic impact. And this is basically what I'm tackling in my 20 minutes, because I will address the economic impact, the consequences of a central bank digital currency, so a retail central bank digital currencies for everybody, and assess the impact on the financial sector and also on the whole economy. Right. So what we currently observe is that there is tremendous momentum with respect to CBDCs. So currently 80% of all central banks work on CBDCs and analyze them. However, there's also a clear trend that no economy actually really rushed into CBDC. So also the ECB is looking into this topic for quite some time, but they have been quite cautious because they stated that there are definitely also risks involved and not just benefits. And what we basically did at the Blockchain Center, we asked experts from central bank, also from academia, from the industry about potential issues of a CBDC. And the majority of our 44 experts here basically stated that there are issues related to financial stability. And this is, of course, something which has to be analyzed carefully before a CBDC is actually been introduced. Also, the Deutsche Bundesbank, in a recent article in the Handelsblatt, argued, so for the non-German people here, it basically says that a digital euro would increase the risk of bank runs. And this is, of course, also something which would impact financial stability in a negative manner. So the Bundesbank actually fears threats with respect to digital bank runs. And this is also something today stressed by Mr. Diel from the Bundesbank, because he said that a CBDC could crowd out bank deposits. So it could lead also to a disintermediation of the financial sector, which is a second component which could negatively affect financial stability of a whole economy. He is quite in line with sharing these potential threats, at least from a CBDC. And here Ulrich Binzahl from the ECB basically also stated that a CBDC should only be launched if risks related to structural disintermediation and also to digital bank runs have been solved. What exactly does this mean? So why can a CBDC lead to structural disintermediation, and what do I mean with that? Basically, if you have a CBDC available, this is a digital form of central bank money. We also discussed this today. And this is a clear difference to our bank deposits, we know, because this is commercial bank money. And with commercial bank money, as a holder, you have a claim against the commercial bank. But with central bank money, you basically have a claim against the central bank. And this is a clear difference because in times of financial distress, banks are potentially fragile and could at least become bankrupt or could come under turmoil, while the central bank cannot. And therefore, this is really an issue related a potential threat imposed by a CBDC if really a large share of bank deposits is transferred to the central bank. So how can you imagine this in reality? For you as a client of your bank in times of crisis, you could decide, well, I now use the money I deposited with my bank and put it to the central bank because I think it has less risk, because maybe I fear that my bank could struggle, maybe as a consequence of some times of crisis. And this could then drive a large-scale disintermediation so that a large share of funds is basically allocated from the banking sector to the central bank. And this would then threaten refinancing of banks and could potentially also drive some kind of a banking crisis. And this is, of course, something which should be prevented from a central bank perspective. And the second risk of financial stability is basically digital bank runs. And here it is often argued that bank runs with a CBDC are way easier to do, because in case of a bank run, you go to your bank and want to withdraw a large fraction of your money. Also, very often because you fear that your bank might struggle and you just want to access your money. And with a CBDC, this can basically be made with one click. So you don't have to drive to your bank to do this. But what you basically see is that you can do this from home. You can do this with one click on your app, right? And this is also why it's argued, or also the ECB argues, that a CBDC could potentially be a threat for financial stability as well, and here in the form of bank runs. So what actually is important from the motivation I just gave is that structured disintermediation as a first aspect and digital bank runs as a second be a result from a CBDC. Very briefly, from a balance sheet perspective, you see here a very simplified balance sheet of a bank. On the left-hand side, of course, the assets, which are loans, also securities, cash, central bank reserves, and on the right side, the liabilities. So basically how the assets are financed, which is mainly bank deposits, also some central bank credit and equity. And if we now have or observe a large-scale disintermediation of the banks, then basically the deposits on the right-hand side would shrink a lot. But the issue is that the deposits are very short-term, but the loans are very long-term. Therefore, the central bank has to refinance itself basically from a different manner. And this is what's the issue behind such a disintermediation, because the central bank, this bank has to look out for some other kinds of fund in order to basically, still have enough funding for loans. Right. So this motivation actually was intended to show you why this disintermediation of the banking sector could be a very important issue. And as we've heard today, also by Mr. Deal and also by Mr. Utzig from the Banking Association, there are lots of questions coming out from CBDCs. And one, for example, is how does this impact banks? How does this impact the real economy? And exactly these questions are we analyzing, or me together with a colleague of mine in our research paper, where we try to get a first guess how large these effects on the financial economy can be. How do we basically do this? When you look at in the reality, we have seen that there is not really a CBDC live in an industrialized countries. So we have increased efforts in China, large-scale testing. We also have the ECB looking into it, but we have just one CBDC live. This is basically in the Bahamas, the Sand Dollar, which has been launched a few weeks ago. But that's the only project. So if you want to analyze the impact a CBDC would have on the financial sector, you cannot do this like empirically because you don't have data. And this is, of course, an issue, because if you don't have data, it's really hard to infer what happens with the financial sector. And this is also nothing you can test with prototypes, because this issue really just comes up as soon as a CBDC is launched and everybody can access this basically. So what you currently have to rely on are like model theoretical analysis. And this is something we do in something where I will present you results today, because we basically developed a so-called dynamic stochastic general equilibrium, so-called DSGE model, which is a tool of models which is heavily used in economics for all kind of analysis, be it for like shocks related to Brexit or COVID-19, or also a shock related to a CBDC. So this is basically a mathematical model in the background which specifies an economy. And of course, these models are not like perfectly describing the reality. However, we think at least that it's a good basis, and our model provides a good basis to analyze this question because it captures main macro dynamics we also have seen in the last financial crisis. Right, but I will definitely, no worries, I will definitely not bore you with some math today. I will just provide and discuss the results. And if you're interested in the approach behind that, you are very welcome to contact me. Right, so what do we find? First, you have to decide between a CBDC, which is interest-bearing and non-interest-bearing, because this is like significantly different. An interest-bearing CBDC would be a CBDC which pays obviously interest. So you could get a positive interest, as in the case for your bank account, for example, but in theory also negative interest rates are possible. So this is an interest-bearing CBDC. And second, there is a non-interest-bearing CBDC. How can you imagine this? A non-interest-bearing CBDC is basically, it's a digital form of cash, right? Because cash does also not pay any interest. So a non-interest-bearing CBDC would just be similar to a digital cash and would not And in our project, we also differentiate and simulate the shock with respect to these two different features of a CBDC. However, today I will just provide the findings for an interest-bearing CBDC, because for the question we just answered about the impact on the financial sector is quite similar in our model. Okay, so what do you see here? You basically see like the development, the dynamics of four variables I just brought as examples today. The first one is bank deposits, then CBDC, central bank reserves as the amount of central bank funding, and the GDP. So what with these pictures, we basically want to show what's the impact on these variables as a reaction to a shock. So as I said, here is the variable which is here like observed. Here on this x-axis, we see the time. So this is in quarters. So 40 obviously means 40 quarters, which is 10 years. And then on the y-axis, you see the deviation from a steady state. This is basically like the deviation from a kind of equilibrium situation. So how you can imagine this is basically that everything works in the economy, everything is fine, and then there is some kind of shock. And then the system reacts, and also the bank deposits, for example, react. So what we did in our model, we introduced a shock which is related to the financial crisis in 2008, starting in 2008. And we wanted to analyze, well, what would have happened if we had a CBDC? So we basically have a model, which is the black line, which is without a CBDC. So this is like the results we kind of have seen for the financial crisis period. And we have like a counterfactual here in red, which is with a CBDC. So we basically ex post estimate what would have happened if we had a financial crisis with a CBDC. So this is again about how you can interpret doing. And now to result. So as I said, we had a crisis situation similar to 2008. And what you see is that without a CBDC, bank deposits here declined by 11%, because this is the risks I just explained in the beginning, that people basically fear that their bank deposits or their banks could struggle and could become at least, could become bankrupt or have some kind of issues. Therefore, people basically go to their bank and withdraw the money. And you see that this effect is stronger with a CBDC. And this is something you would expect, right? Because this is exactly the disintermediation effect I explained in the beginning. Because with CBDC, people have the opportunity to also not just hold their money with your bank account, with your bank, but also with the central bank. And therefore to diversify risk and to also go into some less risky form of money, people use CBDC. And this is why you see a difference between the black and the red line for the bank deposits on the left side on top. Then right next to it, we see CBDC. In a model without CBDC, there is no CBDC, so nothing basically happens. But with a CBDC, we see a very strong increase in CBDC holdings in times of crisis. And this is interesting because this is also something we kind of see in reality, at least comparable with cash, that in times of crisis, people go into cash. So everything is liquidated. We have seen that bank deposits have at least slightly dropped. Government bonds have been sold in lots of economies. Also crypto lost in value, gold. So we've seen that lots of people put their money into some kind of riskless form of money, which is now cash, but in future is a CBDC. So this is quite important. But now what's also important is that banks now, as I come back to the balance sheet later on, have an issue with refinancing because they have refinanced their long-term loans and they have to have some kind of other funding. And what they can now do is they can turn to the central bank and say, well, central bank, we now have an issue. We have lost lots of our deposits. Can you please provide some loans for us? And this is what they also do here. So if we look now in the picture with the central bank reserves, with the central bank funds, basically, so the credit banks get from the central bank, we see that this is basically way higher in a world with CBDC, okay? So that now we see that the banks go to the central bank and basically replace all of the lost deposits with central bank funds to kind of in the end, don't have any refinancing issues, right? And this is quite interesting because in this situation, the increase in central bank refinancing is exactly as big as the decline in bank deposits. So in the end, it doesn't change. The funding, the total funding does not change, but just the And this is interesting because as a result, the balance sheet of the banks is still has the same size. Therefore, the loans are still provided to the production sector with the same size, meaning that the production does not fail. Okay, and you see here on the GDP picture that with a CBDC and without a CBDC, production is not really different. And this is interesting because in such a situation, a CBDC introduction would not yield to disturbances in the financial sector because deposits are just replaced with a credit at the central bank, and GDP would also not be negatively impacted. Okay, and this is like a first quite interesting result we get from our simulation. And from a balance sheet perspective, I also mentioned this. It's just the case that the bank deposits without CBDC on the left, with CBDC on the right, the bank deposits decline and the debt with the central bank increase, so that the total balance sheet, the size of the balance sheet does not really change. Okay, now the second case, which is also quite relevant, I guess, it's now about the case of restricted allotment. So in the previous case, we had the situation that the central bank basically the banks went to the central bank and provided all the differences between deposits and the loss in deposits. And this is quite interesting because if the central bank decides not to do this, so the bank goes to the central bank and says, we want maybe 100 billion, but the central bank says, well, maybe you don't have enough collateral or we don't want to give you that, then this leads to the fact that the balance sheet of the bank shortens because the decline in deposits is not offset by an additional increase in central bank reserves. And then also the production is harmed because GDP decreases more because in total, the funds the bank now has to provide loans and to provide to the industry is now lower. And in such a situation, a CBDC has the potential to destabilize the economy and also to harm production. So again, from a balance sheet perspective, you see without CBDC on the left, with CBDC on the right, that the deposits again decline. The central bank credit increases, but not one-to-one. So the increase in the central bank refinancing is smaller than the decrease in deposits, and therefore the balance sheet of the bank shortens, and as a consequence also the loans decrease. And this then, if less money is available for the economy, less credits are provided, less loans, and the production is harmed. Okay, so this is like two different perspectives of a CBDC. So just very briefly wrap up what I just discussed. Our simulation basically show that CBDC indeed crowd out bank deposits. So in all our case, we see that there is a drop in bank deposits, but that this is not necessarily a threat for financial stability. It basically depends on the central bank. So the central bank has basically all the tools to stabilize the financial sector by providing more central bank funding. So if the central bank decides to replace the lost deposits with a central bank credit, then nothing happens to the real economy because it just changes the composition of the balance sheet of the bank, but not the total size. Okay, so this is very relevant because here you see if the central bank decides to step in as a lender of last resort, it can stabilize the financial sector, can also mitigate this loss in deposits, and therefore the central bank has in theory all the tools basically if they provide the loans to mitigate a financial disturbance. So to maybe include in one sentence, our question was, does a CBDC disturb the financial sector? How is the economic impact? And this depends all on the reaction of the central bank. It can lead to disturbances in the financial sector, but it doesn't have to if the central bank responds adequately from a financial market stability point of view. Thank you very much. As the last information, if you want to read more about this project, we are having the simulation. You're very happy to just scan this QR code. There you find the paper we wrote about it. And in case you want to discuss this, you can reach out to me anytime, LinkedIn, Twitter, email, that's all fine. Thanks for the opportunity to present. And yeah, I'm heading back to you, Manuel.